Yeah, thank you very much, Rebecca, for this kind introduction. Good afternoon, ladies and gentlemen, everyone. I hope that you can all hear me and see me all right. The title of today's webinar is "This is not yet a financial crisis," and what I would like to do is to explore with you the impact of the COVID-19 pandemic on the European banking system. So let me share with you my preliminary observations. I've structured my thoughts into four parts. Let's briefly revisit the starting point. Where is or where was the European banking system at coming out of the great financial crisis at the end of 2019 before the pandemic? In part one. Part two, we will revisit the response to the pandemic, and then in part three, the core of this presentation, we will look at how it is impacting the banks, answering the question whether the banks are part of the solution or part of the problem, and then we will conclude with some final observations. So let me move right into the starting point. What you can see here is taken from the ECB statistical warehouse. These are the 113 significant institutions out of a total of 5,500 banks in the EU. The number of banks has come down in the aftermath of the great financial crisis. And the banking system we're looking at is a banking system of 22 trillion of assets. There are 14.4 trillion of loans. And this accounts for approximately 70% of Eurozone total bank assets. And this compares to a smaller US banking system. And you can also see that the importance of the banking system for the European economy is much bigger than the importance of the US banking system for the US economy. It is a banking system with an ROE of 5.2% in that last quarter of 2019. So below the cost of equity, and that suggests that the banking system had some issues in terms of its business model. Also, the ROA of 0.36% is significantly lower than US banks. So there are some business model issues. But if we look further onto the regulatory position, we can say that on average, it is a resilient banking system with a core equity tier 1 ratio of 14.8%, tier 1 ratio of 16%, and a total capital ratio of 18.4%. There are some issues still in terms of non-performing loans. While the non-performing loan ratio has come down to 3.2%, there are still 500 billion of non-performing loans out there. And the hotspots continue to be Greece, Cyprus, and also Italy, a small percentage here, but with 6.7%, but obviously a large banking system. For comparison purposes, again, the US banking system has less than 1% NPL ratio at the end of 2019. So let's look at how the COVID-19 crisis unfolded and how governments and the ECB have responded to it. So the first question I think we have to ask ourselves is, was this something that was foreseeable? Obviously, in hindsight, it is always easy to say this was foreseeable. But yes, clearly there were signals and early warnings. This is not a black swan event. This is more of a gray swan event. So there were indications in terms of MERS, in terms of SARS, in terms of a discussion in the German Bundestag, but also on the pharmaceutical and medical side. And it is fair to say, however, that most banks and most supervisors did not have this scenario on their radar screen. And in the aftermath of this crisis, we will have to have a debate how we can, better integrate these kind of scenarios into the risk management of banks. And we will also have to see and discuss how effective risk managements really were. So obviously there was a huge shock to the economy that is still unfolding. The pandemic and the lockdowns created a simultaneous supply and demand shock, and also are disrupting global supply chains and trade. Most firms are plunged into a liquidity crisis, which, like in the great financial crisis, might, for those firms, easily morph into a solvency crisis. They therefore were forced to resort to liquidity lines and government-guaranteed pass-through loans, i.e. more debt. And currently, we are seeing lockdown measures that are being relaxed step by step. And we are moving from social distancing to testing, tracing, and tracking. But it's fair to say that testing capacity is still scarce and antibody tests are not 100% reliable. On the positive side, we can also see that a lot of drugs are being investigated, but we need to be mindful of the fact that proper drug trials with control groups to establish safety and efficacy of new drugs take time. And the health capacity constraints that we have been talking about prevent achieving herd immunity very quickly. So the bottom line is this will continue to stay with us for quite some time. There's a possibility of a second and third wave. As we know from the Spanish flu, the second wave was actually more lethal than the first wave. A vaccine is at least 9 to 12 months away, with 10 out of 115 candidates looking promising. Now, for me, that is still a little bit optimistic because this is, very difficult terrain. And if we look at other viruses, it took quite some time to find a vaccine. Now, as a consequence of that, the EU estimated GDP contraction, and I'm looking at the IMF World Economic Outlook, will be minus 7% in 2020. That's the latest forecast, with the second quarter, the current quarter, anywhere between minus 20 and minus 30% year on year. So it is important to note that this shock is much more severe and comes about much faster than what we witnessed in 2008, 2009. So here is the table that we are looking at. It is important to note that the euro area, Germany and Italy here as two examples shown as well, came already into this crisis relatively weak. Also, China was operating just above their 6% target, the US at 2.3% in 2019. And you can see how the forecasts for 2020 have been revised downwards, and I think we will see more downward revisions. Broker estimates for the US are for an 11% GDP decline in 2020, and Christine Lagarde for the euro area, well, I guess it was for the EU, in her last press conference also mentioned a scenario that there could be a contraction of minus 12%. Obviously, the basis scenario is V-shaped, as you can see from the green figures for 2021. But we are not yet there yet, and I also mentioned the risks of second and third waves. Now, what happened in the market? Clearly, this pandemic shock triggered a sharp market correction. I don't have to go into the details. Here you all saw that happening. Risk asset prices have dropped sharply. I think it's also fair to note that the breakdown of the oil market added fuel to the fire. Significant strains emerged in the risky credit market segments, high yield leverage lending and collateralized loan obligations. That is foreshadowing what will be relevant in our discussion about the banks, which is that this economic shock translated and is translating into obviously a significant increase in credit risk, which impacts the banks. There were pressures in short-term commercial paper funding markets, and we have seen episodes of deleveraging and strained liquidity. And clearly, the emerging and frontier markets were at the center of a perfect storm. So what was the reaction of the ECB, first and foremost, the central bank? So, well, yes, they were using and have been using the playbook of the great financial crisis, only much more decisively, much more quickly, and also more massively than in 08 and 09. So the deposit rate is unchanged in negative territory. There was help provided in terms of US dollar funding. That is important for the European banks because the European banks are chronically short US dollar. And we had longer term targeted refinancing operations that were put in place to basically allow the banks to borrow longer term and help them with refinancing their balance sheets. The collateral framework was eased, and also the bank announced more quantitative easing, and most importantly, an pandemic emergency purchase program with a total size of 750 billion for the remainder of 2020. And obviously, it also signaled that it can do more. So I have labeled this whatever it takes, take two and more. Now, we need to be mindful in our discussion about the impact on the financial system and on the banks, that this policy has well-known unintended consequences, well-known side effects. It gives a strong disincentive to fiscal consolidation. It distracts the policymakers from real economic policy changes. It leads to a distortion of prices, and it has significant wealth distribution effects. The key terms in that context are asset price bubbles and the search for yield. And it also leads, and that is important for our discussion on the banking system, to a continuation of a disruption in bank and insurance business models, because the European banks are very dependent on net income margin. 80% roughly of their income is dependent on net income margin. And obviously, in an environment of zero interest rates, a flat interest rate curve, there's little money that banks, can make. Ultimately, there is a risk of delusion, loss of credibility for central banks, erosion of confidence in market economy. And we also have, as a potential unintended consequence, increased risk of on the political side. So now let's move from the monetary front to the fiscal side, and let's look at the fiscal policies. They also came to the rescue, again, also using the playbook of the great financial crisis, and again, but like the ECB, faster and bigger than in the financial crisis. I think it's fair to say that this was and is a bailout of the economy. And what is important to keep in mind, that a bailout of the economy, a bailout of the borrowers, is always a bailout of the lender. So this is also indirectly a bailout of the banks. As Greece was bailed out during the Euro crisis in the aftermath of the great financial crisis. And this bailout was actually a bailout of the banks that were holding Greek paper. This is obviously also a bailout of the lenders. So what are countries doing? Basically everything, not evenly and not at the same size. I'll come to that a little later. But we see them taking equity stakes, engaging in recapitalizations, but more importantly, putting more debt onto the system. So we see government loans, we see credit guarantees. We also see, of course, in Germany, income subsidies for furloughed workers, Kurzarbeitergeld. We have tax deferrals, we have social security deferrals or subsidies. We have debt repayment holidays, both public and privately, as acknowledged by the supervisors. And we also have a temporary relaxation of insolvency rules for corporates. And if you add all of this up, this is at unprecedented levels. And I think it's interesting to note that, Germany is actually on a relative scale doing a lot. Italy on a relative scale is also doing a lot. I've put down the US and Japan in comparison as well. Obviously, this is also a story that is unfolding because governments, as we speak, are considering to do more. Again, we have to look at the unintended consequences and side effects. Obviously, the question is one of moral hazard and fraud and shopping for Corona aid. We see instances of that. We can also conclude that some of the mandatory payment moratoria undermine private investor confidence, at least in some parts. And we also have a debate about competitive distortion across Europe, because as I alluded to, the bailout is not evenly distributed across Europe. We have some countries that are doing a lot and can afford to do a lot, and other countries that can't. Obviously, the typical side effects of government money are crowding out of private investors, wrong incentives. And I think the big question is, what is the exit scenario for government lending when this is all over? Now, where does it leave us? Clearly we'll have more debt. Germany is clearly moving towards 75, 80% debt to GDP ratio. France, there's a discussion emerging whether this will be the new Italy, with government debt to GDP ratios increasing in the direction of 130%. Italy is still the white elephant in the room, with government debt ratio projected to increase to 160%. And then obviously Greece, the debt to GDP ratio is also increasing. So if we look at what the IMF and the IIF have been forecasting, we can basically see that they see an increase in government in debt ratios across all sectors globally from 322% in 2019 to 342% at least over the course of the next year or two. And it is also important to note that we're entering this crisis already with, in aggregate, higher debt level than we had in 2017. So that's important to keep in mind. Now let's look at the banks and explore to what extent they are affected and how they are affected by this economic shock. So the question I'd like to discuss with you now is whether the banks are part of the solution or part of the problem. So clearly, the crisis triggered an immediate surge in demand for bank lending in times of deteriorating credit quality. So the corporate sector in Europe is very dependent on the banks. 80% of the financing of the corporate sector in Europe comes from the banks, and we could see what some people refer to as a dash for cash, driven obviously by the lowest quality rated firms that cannot access the bond market. But we could see that banks' line were drawn down very quickly within weeks, and as a consequence of that, not only there was a big demand on liquidity, but also a big demand on risk capacity, on risk-weighted assets, and therefore also pressure on bank solvency ratios, because we could see a lot of demand for lending despite deteriorating governance. We have also seen anecdotes of foreign banks withdrawing from Europe, which obviously added to the demand that was faced by the domestic banks in Europe in terms of lending. And obviously, the hotspots in terms of credit quality were the oil and gas sector, the automotive sector, but most importantly, leisure, hospitality, airlines, and shipping, and also the SMEs, the self-employed, the gig economy that have limited access or only later access to government-sponsored programs have put pressure on banks and have led to an increasing credit demand. So this obviously begs the question, what does it mean for credit exposure? First and foremost, if we look at the three components to measure credit risk or expected loss, we have to talk about PDs, probabilities of default, loss given default, LGDs, and exposure at a default. It is important to note that, and we'll come to the guidance of the supervisors and regulators a little later, that basically the immediate liquidity and credit support probably prevented an acceleration of short-term probabilities of default. But the loss sharing rules, the super seniority, and the acceleration rights that are baked into some of these government lending programs are weighing heavily on the loss given default, which is another way of saying, if there will be defaults, the effect will be bigger. And the public payment holidays and moratoria obviously adding to the exposure at default. So credit risk is increasing, and ultimately, I think it's unlikely that we will be able to stop the increase in non-performing loans. In the aftermath of the great financial crisis, the non-performing loan exposure peaked at a level of 1 trillion in Europe. It was at a level of 500 billion at the end of 2019, under strong pressure from the ECB and also EBA. But I think we are likely to see again a doubling, if not even tripling, with Italy, Spain, and Greece to be likely hotspots again. And even in Germany, we will see the non-performing loan ratios rise. The post-crisis low in 2019 was at a level of 1.3%, but there are already people out there that are forecasting an increase to more than 4% above the post-great financial crisis peak of 3.3%. Now let's look at liquidity and funding markets. So we looked at the impact on credit risk, and now let's look at the liquidity. Clearly the system is and has been under stress because the joint supervisory teams have been looking and monitoring the liquidity position of the largest banks that are supervised by the ECB on a daily basis in this environment. And as I mentioned, there have been pressures in terms of getting access to US dollar funding that have somewhat been eased after the US Fed intervened and announced enhancements to the swap lines. Now, credit risk and liquidity risks are not the only risks that banks are faced with in this crisis. Obviously, there is also market risk. So we have seen and we are seeing obviously significant negative fair value market hits. The important thing is that there has not been that strong of an offsetting effect in terms of bond spreads tightening, and also the equity markets, the junk bond markets, and also the swap markets saw a significant increase in volatility and spread widening. Obviously, that was also partly an opportunity for the banks, those that could provide hedge instruments in terms of equity derivatives, and that has had a sizable fixed income, currency, and commodity business benefited, at least in the first quarter. We've also seen a sudden surge in investment grade debt underwriting recently, but this is benefiting a few banks and not all of the banks in the banking system. Now, the question is now, what have the regulators and supervisors done? Well, they have taken very, very strong counter-cyclical measures. That's another way of saying they have created regulatory headroom. They clearly want the banks to be part of the solution. So they have made room in terms of the banks absorbing both losses from the crisis, but also being able to grow their balance sheet and continue to lend. So it was very important to prevent a credit squeeze. So what have the regulators done? They have postponed the finalization of Basel III. They have brought forward the inclusion of certain subordinated instruments into the Pillar 2 buffer that is approximately worth 90 basis points of core equity tier 1 ratio. They have also basically began to soften the IFRS 9 expected credit loss provisioning rules, which basically originally foresaw banks to take provisions once there was a significant increase in credit risk, provisions over the lifetime expected credit loss. But now this approach has been softened. So the supervisors, the regulators, allowing the banks to look through this crisis. And so they have softened those rules as well. And there was more relief because the supervisors also basically allowed banks to temporarily operate below the levels of capital defined by the countercyclical buffer. That is worth 250 basis points, and also below the requirements of the Pillar 2 guidance. That's another 150 basis points. And they also encouraged the national macroprudential authorities to relax the countercyclical buffer, which was unfortunately only worth 30 basis points. But this all happened in a matter of days and weeks. And if you want, the regulatory and supervisory community has relaxed, all of those thresholds that were put in place in the aftermath of the great financial crisis to make sure that banks can absorb this shock. So what are banks doing? Before we get there, let me also mention that obviously they have also started to give banks a hint to preserve their capital base. So they have strongly urged them to stop share buyback programs. They have asked them to withhold dividends. And but they have not yet encouraged banks to raise more equity, which is also interesting to note in that context. So what are banks doing? Banks are obviously still accruing net interest income throughout the payment holidays, and they are also provisioning, of course, but the weak and low structural profitability of the European banks prevents them from provisioning as aggressively as the US banks. So if you compare the top 6 US banks, what they announced in terms of first quarter loan loss provisioning, that amounted to 25 billion, and that was a 5-fold increase from what they provisioned in the first quarter of 2020. With top European and Swiss banks, then they only quote unquote increased their loan loss provisions 2.5-fold, and that obviously is an early indicator that there is an affordability element in loan loss provisioning happening. And I think it's fair to say that the market expects more hits to come at the half year and full year 2020 marks. Current quarterly reports are oftentimes unaudited, and I already mentioned the affordability principle. And what is also important to note, formal covenant breaches will only officially become known to the banks in the course of the second quarter and the second half. So we will see increasing provisioning levels despite the relaxation of the rules, I would think. So now the question is, what does the market say in terms of whether the banks are part of the solution or part of the problem? We've seen a significant share price decline that was actually bigger than the CET1 that was consumed in the 2018 stress test. By the way, that 2018 stress test only foresaw a 2.7% decline in GDP over 3 years, which obviously pales in comparison with what the real stress test that is unfolding now is actually producing. And the market valuations of European banks continue to fall below a level of 0.5 times tangible book value. So that is not only, approaching historic lows, but it's also significantly lower than the US peers, which suggests that the market anticipates significant trouble ahead if fiscal policies cannot stop the acceleration of probability of defaults. Also, the subordinated markets are telling us that that there is certainly an element of stress that is being priced in. The rating agencies have begun to put bank equity and debt instruments on rating watch negative. And also the European Systemic Risk Board is showing a steep increase in terms of probabilities of defaults at the sovereign level as well as at the large complex banking group level. So the market is saying that the banks could be part of the problem. Now the question is, can we really rule out a bailout here? And more importantly, will the regulatory headroom that has been created, will that be enough? Will that be used up by the banks? I would say there's a high chance that the banks will need that regulatory headroom, the banking system as a whole. And let us look at it more in detail. What I've put down here for you is a back of the envelope calculation. So as we discussed earlier, the government measures are basically leading to a capping of probabilities of default. They increase the loss given defaults, and it is then also important to note that we have had certain elements of supervisory forbearance or lowering the bar, which was the waiver of the counter-cyclical buffer, the relaxation of the Pillar 2 guidance, and also reduction in the Pillar 2 requirements. And then first and foremost, but only with a small contribution, the elimination of the counter-cyclical buffer. All in all, according to my back-of-the-envelope calculations, this adds up to a total relief of 520 basis points worth of CET1 relief. Let's now look at whether this is enough. So the starting point of the banking system, if we take the significant institutions that are under the ECB supervision as a pass pro toto, was 1,480 basis points, core equity tier 1 ratio of 14.8%. And if we assume, for instance, as one scenario, tripling of non-performing loans from 500 billion to 1.5 trillion, i.e. an increase of 1 trillion, then if we assume a loss given default of 50%, then we can reckon with ultimate charge-offs of 500 billion, which equates to 600 basis points of CET1. Or if we, as a very simple rule of thumb, assume that there are 12 percentage points of loss in GDP, and that every percentage point equates to 25 basis points of loan loss provisioning, then we can also come to a number that is in that same order of magnitude, 550 basis points of CET1 that could be at risk from this crisis. So where does it leave us if we basically say we're facing a reduction of more than a third of the core equity tier 1 capital? We also add some returns on that capital, albeit at a depressed level. Then I would say, roughly speaking, the system holds. So this back of the envelope calculation gives us an idea of how big a shock the system can absorb, and whether the headroom is big enough. Obviously, this is a very simplified calculation because it doesn't consider market risk and operational risk. It doesn't consider rating migration, albeit we have only assumed that this is playing out over 2 years, which is obviously aggressive. These are averages. So the question always in a banking system is who is the weak link, who will be the first one to fail the real stress test. And then obviously there are contagion risks in a bank system. And ultimately the question is, can banks absorb another wave of infections, another lockdown? But one thing is clear, it will take the European banking system, I would provocatively venture to say, another 10 years to rebuild their capital base back to the pre-pandemic level. So this has implications for business models, this has implications also for capital increases, and this has implications for also more consolidation. Now, let's conclude basically by looking at where does it leave us in terms of the European banking system. So I would say there are some old fault lines that we need to consider, and there are also new fault lines as a consequence of this crisis. Clearly, what is happening is reducing the transparency and comparability of bank balance sheets in terms of loan loss provisioning and NPLs. And the banks will pay a certain price in terms of bigger discounts and also increased spreads for subordinated instruments. Clearly, the pro-cyclicality of the Basel framework was somewhat mitigated, but clearly, the counter-cyclical buffer was too small with 30 basis points versus a maximum of 250 basis points. As I mentioned earlier, this was left at the discretion of national governments. So that's maybe something that needs to be considered. Also, with liquidity and solvency thresholds and bank leverage and the counter-cyclical buffer being gone right now, we are back again in the situation before the great financial crisis with the banking system that doesn't have a capital buffer anymore, but just has one single trigger, which leaves little reaction time. There's also a question of, of whether this kicking the can down the road can last forever. We also have the well-known fault line again of non-performing loans and zombie economics, i.e. the incestuous relationship between zombie banks and zombie firms that is weighing on the recovery and also on structural reforms. And as I outlined, there is a strong risk that interest rates will be lower for much longer, which earns to bank earning woes and is significantly slowing down the post-crisis rebuild of the capital base. And clearly, we also need to watch out for a reignition of the doom loop because, as I said, government debt levels are increasing rapidly, and European banks, in contrast to the US peers, are holding a lot of government, a lot of sovereign debt on their balance sheet, still zero risk weighted. And that is obviously still a risk in terms of the doom loop. So what are some of the new fault lines? Clearly this bailout is creating some inequity and lack of financial inclusion because not everybody is and can be reached by these government aid programs. Either they're not available in some countries in the Eurozone or it is difficult to get to the people. There is also significant borrower and lender moral hazard, but I guess that's the typical trade-off between speed and scale of emergency lending programs. I talked about the heterogeneity of these bailout programs across the EU, which from a German perspective, obviously creates some competitive advantage, but overall it obviously creates competitive distortion across the common market. I talked about the increased government influence, and there are new risks that we need to deal with amidst all of this, which are cyber risks. And let's not forget also the restructuring of the bank loan portfolios towards ESG is happening. So there are a lot of new fault lines. So let me close with a few afterthoughts. So first of all, I think we need to really consider whether and for how long we can continue with corporate leverage without limits. I've called this here extend and pretend political lending. And an alternative is obviously a more market-based solution that would basically be more prepackaged and more faster insolvency procedures and accelerated restructurings of the capital structure, because one thing is clear, the system needs more equity. The other thing is obviously that at the European level, we have, again, the debate, not unlike after the great financial crisis, about sovereign debt solidarity and sustainability. So that's basically something that is being debated right now in terms of also increasing the lending capacity and lowering the covenants for ESM lending to Eurozone and European member countries. But obviously also in the sovereign space, I think we will have to have a debate about debt sustainability and also the question of whether and how we can get to ultimately sovereign debt restructurings in the Eurozone. And last but not least, there are obviously timing inconsistencies and also political spillovers. Just one thought experiment. I don't think it is really comforting to know that that obviously the resilience of the European banking system would have been a different one if the virus outbreak had hit us 3-4 years ago. So that's something to keep in mind. So in that sense, we were also lucky in terms of the timing. So where does it leave us in terms of my summary? I would say the bad news is that the banking system will be hit hard by the pandemic as a simultaneous supply and demand shock translates into a credit risk shock. The good news is that because of the decisive actions of governments and the ECB, but at the expense, of course, of significant side effects, unintended consequences, I think the system for now can weather the storm, but we have our work well cut out in terms of strengthening the European banking system as we come out of the crisis and while at the same time addressing some of the fault lines that I outlined for you. With that, I conclude my seminar presentation. I hand it back to Rebecca. Thank you for your attention, and I'm looking forward to having your questions. Let me also point out that those of you that don't, get to me in the seminar, feel free to email me at my WHU email address, axel.wieandt@whu.edu. Thank you very much, and back over to you, Rebecca, or back over to you, Verena, who are helping us with taking your questions. Thank you.
Thank you so much, Professor Wieandt, for sharing your insights. Meanwhile, of course, our participants already asked some questions, and of course, dear participants, you are still invited to continue asking questions via our FAQ section. Some of these questions are going into the direction of inflation forecasts. How realistic are scenarios of hyperinflation? Could you elaborate on that a bit?
Well, in my mind, currently in the near future, that is something that is in the immediate future. I don't see that happening, but obviously, with new scarcity of goods and with the level of debt we have, I think there is a chance, of course, and that is what also markets are to a certain degree telling us that inflation might at some point in time increase. That could also be, driven by a loss in currencies, and I think that that will, obviously also make the job, more difficult for banks. Real interest rates would become, even more negative.
One participant had a question regarding the business model differences you mentioned. What is the reason for the lower profitability of the EU versus the US banks?
I think that basically has to do with market structure. Point number one. So there's an overcapacity of banks in Europe, as I alluded to. Number two, the governments itself are players in the banking system, directly or indirectly, and they have different return requirements. So put another way, the flip side of this lower return to a certain degree is that consumers enjoy lower lending rates. So there's also obviously a political component involved here, and last but not least, the U.S. system is not that dependent on the banks, so the banks can be more picky in terms of what they underwrite in the US.
So let me continue with a question, which is, what do you expect as an effect of this crisis on fixed income markets, so bond markets?
Well, I think that clearly we have seen major dislocations in the bond market, and we have seen spread widenings even in the investment grade space. Now, I think that the biggest stress will be in the lower quality segments, and in those sectors that are most affected by this crisis. I mentioned some of those sectors, and we will see continued stress in the bond markets, and that's why the central banks have reacted with bond purchase programs, and the Fed has gone so far to even buy bonds from issuers in the primary markets. So the bond market will be clearly under stress in those segments and in those rating classes that are most affected by the crisis.
WHU is also a business school producing graduates, and I most likely assume that there's one of our students who will graduate this year asking, what is your recommendation for graduates of business schools who wanted to enter the finance sector this year? Do you have some advice for our graduates?
Well, look, I think the fintech movement and the digitalization of the finance industry will have to accelerate, because as far as the banks go, some of these business models, some of these cost bases are not sustainable, and I think one of the only ways out of that is more digitalization of business models and new business models that appear as a consequence of that, and I would focus on those areas. And the second point I would have is also focus on anything that has to do with restructuring, because we will see insolvencies rising, and we will see restructuring work increasing.
One question in the direction of the German banking landscape. Do you expect the long, or at least the participant says long overdue consolidation of the German banking landscape happen as a consequence of the Corona crisis?
Well, we've had some consolidation already over the last few years. It has happened silently in two of the three sectors, the savings bank sector, but also the cooperative banking sector. I think consolidation will definitely continue, will have to continue. Obviously, the middle of the crisis is not a good point in time, but as we come out of the crisis, there will be more consolidation because the push to digitalization will require investments, and obviously, if they can be spread over bigger customer bases, the better. But it's not a panacea; it's not a solution for everything. Consolidation. It is very difficult to basically to execute, in particular in an environment of this heightened uncertainty. So I would think that we need to at least get really beyond and through this crisis before anything major can happen.
Would you say that the measures taken after financial crisis in 2008 have already shown effect in this crisis?
Yeah, definitely. I think as I outlined, and I only alluded to that in the introduction when I was talking about the European banking system, we have spent the last 10 years after the financial crisis really building up the capital basis of the of the banks. So clearly the banking system has become more resilient, and I think in hindsight that was the right thing to do, because imagine where we would be with the capital base and the leverage in the banking system that we had in 2007.
So another question is from one of our participants, who imagines that there will be a rather quick recovery of private companies' finances, but probably the effect of this Corona crisis will weigh on public finances for years. That's with a question mark. So would you agree to that? And as a result, sovereign ratings could decrease and remain at sub-investment grade level for a while. So do you think the ECB will keep the changed collateral framework in place?
Look, they have changed the collateral framework as I've pointed out. Clearly, I think with these kind of measures, if you start something and then try to take it back, the regulators, the supervisors are in a difficult position, because the last thing they want is to trigger a new crisis when they take something back. So that means I think the focus will be on really seeing whether these ratings can and will improve, because ultimately the credit quality and the stability of the ECB's balance sheet is the holy grail. But I would think that this will take some time. We will see more downgrades, and there will be a question of, as I said, of European instruments, of Eurozone instruments, but there will also be a question of ultimately, higher tax rates. So somehow we all will have to pay for the bill that is being created right now.
You mentioned in your presentation a couple of industries that are hit quite hard. One of our attendees is interested in which industrial sectors do you expect to be most stable in the course of this pandemic? And or are there clear winners in this pandemic situation?
Yeah, clearly the big tech companies are clear winners. They had a lot of cash going into the crisis and everything that has to do with digital, provided it is safe from hacking and bombing and what have you not, I think is a clear winner and will continue to win. The second sector is, although you have to be careful and sort of differentiate between pockets, the second clear winner is the healthcare system, and also food retailing was a winner, although we have to see how that plays out in terms of the food logistics and the food supply chain. But I would clearly say e-commerce, online, media streaming, online infrastructure providers, that is clearly something that is on the winning side.
And we do have quite a number of questions open still, but unfortunately our time is running out. So I'm choosing one last question right now. And this question is whether you could comment on on fintechs, how fintechs could be part of the solution right now, how fintech is an opportunity in the current situation.
Well, clearly, fintechs are developing very efficient business models to basically service and satisfy basic financial needs. So in that sense, they show the way in terms of more efficient, more diverse, more open business models for the banking industry. So they will definitely be part of the solution. Obviously, more broadly speaking, some fintechs are also under pressure in this crisis. And the last point I would like to make is that I think fintechs could actually, and in particular, lending platforms could play a role in terms of reaching some parts of the population that couldn't be reached that quickly by the banks, and online processes, online underwriting processes are very efficient and also very, very scalable. So that's something I think to consider also by policymakers.
So with that, our time is already running out. So I would like to thank you a lot, Professor Wieandt, for being with us today. There was a lot of interest, a lot of more questions, but thanks for touching upon a couple of them. Thank you very much to all our participants of today. It was good having you with us, and hopefully we'll see you again or hear from you again in one of our next webinars. Thank you very much.
Yeah, thank you very much for having me, and have a good afternoon. Thank you very much.